Valuations is a very subjective exercise. Just like beauty, it probably lies in the eyes or minds of the person who is doing the valuation. And to add it, there are multiple parameters that are used to decide whether a stock is overvalued or undervalued. Uh, Probably the most common of all these parameters is the price earnings multiple. So price earnings multiple is the current market price divided by the earnings per share of the company. And the common logic is higher the P multiple, more expensive the stock, and if the P multiple is low, then the stock is relatively cheap. And while that might be the case, the problem is in concluding that a low PE stock is a better bet than a high PE stock because it is cheap. Another aspect with respect to valuation is which number or what PE ratio is actually a reasonable or good to enter number, and at what number should we exit a stock. Particularly with respect to indices like the Nifty, there is so much of content which says that P of Nifty below a particular level, then sell everything and buy the Nifty. P above a particular level, then just liquidate all your positions and get out of the market because the P levels are so high. So maybe we'll try and understand what exactly is this price earnings multiple and how to make sense out of it. To begin with, let us reverse the PE multiple, then it becomes earnings per share divided by current market price. And this makes more sense because this effectively means earnings yield. Meaning, if I am investing 100 rupees and I am getting say 5 rupees, then my earnings yield is 5%. P multiple is the reverse of it. For getting 5 rupees, I am paying 100 rupees. So for 1 rupee of earnings, I am paying 100 by 5, that is 20 rupees. So 5% earnings yield or at 20p is more or less the same. We are just looking at it from two different angles. But looking at the earnings yield will give us a lot of perspective on P ratio. Take for example a bank deposit. Nobody talks of price earnings multiple for a bank deposit. But a bank deposit also has an earnings yield. For example, and I'm taking some easy numbers here, let us say a bank offers 10% interest. Now that's a long number, quite high, and probably will not see it in at least the near future. But for example purposes, let's say a bank is offering 10% interest. So for the 10%, let's say we do a fixed deposit of 100. So 100 rupees is my investment, 10 rupees is my interest. So earnings yield is 10 by 100 or 10%. Now reverse it. The P multiple of a bank deposit offering 10% interest is 100 by 10 or 10. If I'm talking about a P of a bank fixed deposit of 5%, that translates to a P multiple of 20. So a simple investment like a fixed deposit where you do not see any upside on the returns, whether you do a 5-year FD or 7-year FD or whatever is the stated interest rate, that is the interest you will earn. So in the current low interest rate regime, where banks are offering 5-6% interest, this translates to, take 6% interest on a fixed deposit. This translates to about 16.67 PE multiple. Now, if an investment where there is no upside to the returns that are being earned, because the bank deposit is going to give same amount of interest. If for such an investment the price earnings multiple is 16.67, then an investment which promises increasing returns year after year should definitely command a much higher price. And therefore, anticipating or expecting P multiple of 12 or 15 on indices like Nifty is probably no very unreasonable. We are unlikely to see P numbers on indices like Nifty going down to 12 or 15. And by the same logic, if at one point in time we talked about P multiples of 25 being too expensive, in the current context of low interest rates, that is not going to happen. 25p works out to an earnings yield of 4%, which again is quite high. From a stock return perspective, so as and a low interest regime essentially means low inflation, low risk, and a relatively low opportunity cost of money. And in each of these cases, it means you can pay a lot more for stocks that are likely to return much higher. And therefore, expecting or anticipating low Ps may not be a very reasonable strategy for an investor. We need to detach ourselves from the stereotyping of P multiple being lower than a particular number or being higher than a particular number. We need to accept the Ps of stocks as given, because there are dynamics in. There will be organizations, companies whose Ps will be much higher, and they have continued to be very high. And there will be organizations whose Ps are much lower. Even in current scenario, where I explained that a bank FD can give you a P of 16, you will have companies with single digit Ps, and again the market has its own reasons to assign a low P. A low P does not necessarily mean a great investment, because the market is probably anticipating that the stock can run into some kind of turbulence, future earnings look doubtful or are likely to fall, and therefore many analysts talk about forward Ps rather than Ps based on historical earnings. Companies with very high unreasonable Ps, we've seen in recent times IPOs coming up with Ps in excess of 200, 300, and if I'm not wrong, one company had a P in excess of 1000. Now, despite the great growth potential that these organizations may have, investors need to be very wary of these kind of valuations. Does the company really have in it to deliver growth, earnings growth, at such a high level that can justify the high price that we are paying for it? Analysts often use another number called price earnings growth multiple, that is PEG ratio. This particular ratio tries to factor in the growth rate of earnings, so that an investor has an idea in terms of how much are we paying for a company which is growing versus a company which is not growing. So a company with a high P multiple but with a reasonable PEG, textbooks often say that a PEG of 1 is ideal, more than 1 is expensive, but then as I said, these numbers cannot be taken at a static level. We have to keep in mind the dynamics of the markets. So if we are having a stock which has got high PE but a sober PEG, then it might still make a lot of sense to invest in this quote unquote high PE stock. Very often, high PE stocks deliver much higher returns or better returns than low PE stocks, because low PE stocks kind of get stuck. They face issues. Sometimes it could be quality of management, sometimes it could be uh, obstacles to growth, which the market is able to see, but those numbers are not reflected in the financial statements. Therefore, an investor should not look at P numbers in isolation and decide investments based on this strategy of picking low PE stocks, thinking that because these are relatively low PE stocks and there are other companies in the same industry commanding a higher PE, then this stock will eventually catch up and deliver returns. Can that might not happen, and the investor kind of gets trapped into what can be called as a value trap, because you're thinking that there's value in this stock while there might actually be issues. So investors need to be open with respect to what price they are paying and whether they see value in the stock, not in terms of valuation multiples like P ratio or price to book value ratio, etc. There are multiple such uh, parameters. These days, startups are valued on a price to revenues basis. And obviously, the reason why these numbers are thrown up is because there is a logic behind that. But for a conventional investor, the price earnings multiple has to be reasonable. We should not be blinded by numbers that are loosely talked about, saying that P lower than this is a steal or a P higher than this is a no kind of a thing. Every stock has to be evaluated on its merits and in terms of its what at least we call it as the roots and wings philosophy.